From the morning reading. The morning rally fades on Thursday afternoon. The IWM leads with a gain. Market breadth strengthened compared to the prior session as advancers led 1939 to 1034 on the New York Stock Exchange and led 1820 to 1024 on the NASDAQ. In other news, the falling dollar contributes to a rising emerging market, currencies and stocks. The Mexican peso and the stock ETF also gained ground. A rising yuan is helping boost Chinese stocks. Stock gains evaporate on postponement of the healthcare vote. Hedge funds are pulling back after reaching one of the most exposed levels in 15 years. Hedge funds have started to lessen their positions in stocks. There have been 3 other times that they were as exposed as they were in the past month, and when they started to pull back and volatility rose, stocks fell hard and fast. Active managers are pulling back too. According to the NAIM organization, their survey of active investing managers is showing the least exposure to stocks in months. The 4 other times they pulled back after spending months heavily exposed to stocks, the S&P 500 took off to the upside. If the S&P dips below the 2300 at any point in the next 2 months, then we'll have evidence that this time is different. The Dow can't catch a break. The Dow Jones has been down 6 days in a row, but its total loss has been minor, and it's in a clear long-term uptrend. Since 1960, this has led to a positive return on the Dow every time during the next month. Mexico is loved once again. It has the most optimism of any other ETF. When its optimism index has been above 80 and the 10-day average above 70, over the next 3 days, it added to its gains only 34% of the time, 41 out of 121 days, averaging a negative 0.7%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:48 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 24th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we've got the S&P futures up just above scratch, Russell futures up about 1/3%, NASDAQ and Dow futures up just above scratch. Crude oil futures are up about 2/3%. Euro's up just above scratch, as is the long bond. Gold is down just below scratch. In overseas action, looks like everybody's participating. China up about 2/3%. Hong Kong up just above scratch. Japan up almost 1%. Europe is a bit weaker, with both Germany and the United Kingdom down just below scratch. In terms of macroeconomic reports for today for the United States of note, you have core durable goods, and that's about it. In terms of current volatility conditions, obviously we've been seeing some increasing volatility. Short-term VIX now up to a 15.14. That's about the highest we've seen short-term VIX in quite some time. SKU still elevated, though not quite as excessively elevated as it has been in some recent sessions, currently running 132.5. IV percentiles still extremely low in the big scheme of things on a 52-week comparison, but also higher than they have been many times in recent sessions. In the S&P at 20, the Russell at 30, the NASDAQ at 24, the Dow at 28. No standard deviation size moves were put in on yesterday's action on a close-to-close basis. Just a couple notes here. A couple days obviously ago, we had these really big moves, and a 4 standard deviation move is, from a statistical sense, that's only supposed to happen like once every 43 years. And this 3 standard deviation move is something that's supposed to only happen about once a year. So these were really extraordinary moves, and this gives you some idea just how much importance the market puts into this healthcare vote that Congress is currently working through. And, it could go back and forth. They're calling for postponement, or they may vote for it today. Trump is wanting them to vote. Either way, understand that when that vote occurs or gets postponed, that could be a market mover. So we talked about macroeconomic reports for today. We were talking about regularly scheduled economic reports. Well, there's very few things that affect the U.S. economy more than the cost of healthcare. It's a substantial part of the overall budget for many, many companies. So any significant change in how healthcare is delivered could roil through the markets in a significant way. So think of that as your like a Fed announcement today, in effect. That could be a market mover if anything of significance happens to come through on a vote. So that's enough on that. Let's go ahead and go to the charts. And with what I just said, understanding that much like this session here, where you had, some feeling that, there may not be a change in healthcare, and the market dropped 3 and 4 standard deviations across the indices, that again could happen today or anytime that a vote moves forward. So we could see a rip your face move to the upside. And that would be probably associated with an approval of the vote, or we could see a significant move to the downside if we get further clarity that there's more problems ahead on the vote. So this sideways action here in the last 3 sessions, 2.5 sessions, this is the overnight session here, this is largely attributed to expectations or lack of clarity as to where we're going with this big vote that's in front of the House right now. So just keep all that in mind. While we've been sideways, some people could argue without any awareness of the news that, okay, we had a breakdown, and then we've had indecision here. And, for a little while there yesterday, it almost looked like we were going to have what they call a K-hold, a close above the high of a low day. And that's often a reversal point, but then you see that was then rejected, and thus far in last night's overnight session, significant activity. So ultimately, the market seems to be signaling that it is watching for a result to come out. It's the same thing with the Dow futures. No real change there from the first story. The NASDAQ has been a bit stronger in that it did have more of a bounce, and it's been largely sideways in the last 1.5 days. And then on the Russell did have a close above the high of a low day. This would seem to be setting up for a reversal on the Russell, so it might be leading to the upside as of this point, but I wouldn't get too much out in front, too aggressive out in front of a big vote such as what might be happening today. In other markets, you have crude oil. Crude oil, of course, has broken down, has been quite weak, and below the cloud, below all the key moving average lines, this is probability-wise is pointing to further downside action. In terms of gold, gold has been a real challenge for technical analysis for a number of months with kind of these classic undercuts of, that theoretically shouldn't be happening if you're in an intermediate term bullish move, and then you have the breakdown, and then just when you think the breakdown is obvious and you're in a classic intermediate term bearish, you get this huge reversal here, which seems to be, a retracement that's gone too far, much like this one here, going the other direction. So what do you do with that at this point? Is this setting up for a higher high? Or is this going to be a lower high and we're going to be next seeing a lower low? Not terribly simple to discern which direction gold is going in the intermediate term at this point. Very, very sloppy charts. Now, one of the keys to that could be the dollar. And when we look at the dollar ETF, we see certainly the dollar's had quite a bit of weakness of late, and that certainly has rolled through the emerging markets. And we take a look at EEM. So, you know, the emerging markets do well on a cheap dollar, and also EMA. I thought it was EMA. Seem to be having trouble pulling that one up. Well, we'll go EEM again. EEM, emerging markets, doing well on this recent weakening dollar. Okay. Also, let's take a look at bonds. Bonds also, you know, big breakdown of recent, bit of a retracement, but, you know, this is one of the clearer paths where you have a pretty high probability expectation that this thing's going to continue to make lower lows. And then finally, let's take a look at volatility. And you see the regular VIX product has climbed a bit of an increase in volatility here of late. We're currently, well, yesterday closed at a 13. It's the first time it's closed above a 13 in a very long time. Looks like we have to go all the way back to the end of December, just before New Year's, the last time we had closes above a 13. So while significant that we've come from this very low volatility area into the 13 handle, remember we consider 12 to 15 to be just normal bull market volatility. And so we've really just gone from very low to relatively low volatility. We note the increase. We watch to see if this further develops, but we don't want to make too much of this at this point. The market is not signaling fear, and indeed, if you think about these recent moves, while they're certainly understood to be related to the healthcare vote and perhaps, you know, implications for further legislation like tax reform and regulatory reform, and the ability of the administration to push its will through Congress, the same time the market's not expressing high degrees of fear that the economy is going to be doing poorly. So these things are always in relative terms, and right now, while we do have increasing volatility, this is not something that is extremely fearful. That's more of your VIX 15, 16, 18, even 20 plus. That's fear. Fear is not a VIX at a 13. Okay, that's probably enough on the charts. Let's go to the daily report. And as you would expect, we continue to see some signs of deterioration here. Market phase 5, the break of diagonal and horizontal support. So this is no longer a weak warning. It's a much stronger warning with that break of the horizontal support. In terms of the three market timing signals, uptrend under pressure. So the first real significant break from bullish signals that we've had in some time. That's coming from IBD. GMI index also has been continuing to deteriorate. It's a 3 out of 6 at this point, though it does still retain its buy signal that's been in place since 11:10. And then the third signal comes from Stock Charts Decision Point Scoreboard, and you see further continuation of the deterioration here in the short term. Almost all of our signals now are either bearish or at best neutral on the short term. Now, the intermediate and long term, nothing's changed there in recent sessions, still holding on to bullish signals. And that's one of the reasons why we caution not to overreact to the short term weakness in excessive ways. Take note, take some early actions, perhaps take some profits, shorten up some targets, perhaps start putting on some of those short to intermediate term hedges if you've not already done so. But certainly this is not yet a situation where the risk levels are exceptionally high. Position sizing opinion models, we do have one model coming in at 50%, the other model coming in at 75 to 100%. In terms of the intermediate term market posture, we have a weak bear and a falling sentiment line. So these are definitely further warnings for the bulls that, the deterioration has been setting up. Further, we look at the absolute scores on these, and we see they continue to weaken. It's currently a 63 for the S&P, a 65 for the Dow, and the Nasdaq's also now in a weak bear. It had been holding on to its exceptionally strong bull a bit longer than the other indices. It has now joined the S&P, the Dow, and even the Russell with these weak to strong bears. You see the Russell's in danger of actually falling into the exceptionally strong bearish category if that score continues to deteriorate. Now with this falling sentiment line, we would be expecting that the bearish moves, the bearish legs, could be a bit more persistent, a bit more drawn out, a bit deeper than we would in a normal kind of rising sentiment line. Hedge warning status remains level 1. This is our caution light, and this is a very important level because it is the first kind of time in which we've gone from kind of normal market risk levels to where we have increasing risk, and we want to start to pay increasing attention to the signs and symptoms of a deteriorating market when we are in this caution light level 1. By itself, not horribly scary, but it's an early sign, and it could very quickly go to level 2 or even 3 in a couple 3 sessions from a level 1 if situations continue to deteriorate and we start to see a bit of a waterfall develop. In terms of strategy opinions, the cover calls, the put selling, this could be an opportunity to buy, yet also could be an opportunity for continued deterioration. So a bit more conservativeness than you had perhaps a week ago to be able to kind of play in these different scenarios. I frankly right now I'm looking for signs of bottoming action and some resolution to the current situation with the healthcare bill before I want to feel like I know that the bottom is in. And I do not yet see the signs that, a bottom is confirmed. You could see some evidence that perhaps a bottom has started to form, potentially, but you do not yet have confirmation on any kind of bottoming action, nor will you likely until we get some resolution out of the House. In terms of specific areas of warning, there's a sea of red here, and this is part of the reason why I'm pretty hesitant to get too much out in front of this with new bullish positions. You see under the volatility area, market in decline, sharp increase warning. You have, for the first time in a very, very long time, the VIX daily squeeze has fired. So we do have what seems to be an exit from the squeeze, and that often portends, a rapid increase in volatility. You have distribution day counts on the S&P and the Nasdaq that are in the warning area. The VIX phase has been increasing. Skew is elevated. The 10-day out expected move is actually in excess of 40. That should be a greater than 40. So that is in warning category. In the trend area, 2 of the 3 indicators are in warning, and the third one is just simply kind of neutral. In the intermarket risk aversion indicators, all 5 are currently in risk off, and 4 of the 5 of those have pretty decent angle and separation, so are pretty strong indicators to the risk off side. From the fear and greed index, we get a 30, so sentiment is also continuing to deteriorate to the downside, and if this drops below a 25, we will drop into the extreme fear category. In terms of sector specific, take a look here, and it's a bit of mix yesterday in terms of risk on and risk off. You have in the risk on category, materials, financial, and consumer discretionary putting in positive days. And the risk off, you have real estate, and then not too far down here, telecom and utilities. But These were actually mildly negative and with some relatively poor breadth. Consumer staples, the same thing, relatively poor breadth and a negative day. So this was really not a risk on or risk off kind of rotation yesterday. In terms of looking at market posture by sector specific, really the only two sectors that have been holding up across all the different time frames of late are utilities. We've talked a lot about utilities in recent sessions, as well as materials. So those are perhaps the best and most consistent performing of late. On the flip side, the worst performing has been retail and energy, and that followed by telecom, but energy and retail continue to be particularly consistent to the downside. And you see this recent performance is starting to bleed through the different time frames, not just a 1 day here and there, but the 1 week rolling and the 1 month rolling. Most of the sectors now are negative on the 1 month rolling time frame. So I think that's probably enough for today. We've gone just over 20 minutes. Let me go through these slides and get this thing to production. Disclaimers as always. If you need more time to review the disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. Manage that risk profile and you'll find much more consistent trading out there, a lot less stress in your trading and investing activities. In the meantime, good trading to you.